Hello everyone, I'm Kenshin. Welcome to Speaking History. Today's historical discussion is about the bank panic of 1907. Please subscribe, like, comment, share, and don't forget to ring the bell. Thanks. Since the end of 2022, bad news has been continuously coming out from Silicon Valley, which is often considered a privileged place. To begin with, high-tech giants like Microsoft, Meta, Twitter, and Amazon have been reportedly laying off employees to improve their financial statements. In other words, they are slimming down for survival. It is worth mentioning that during the pandemic, these companies were heavily hiring, seemingly indicating the end of their past glory days. However, the bad news doesn't stop there. Silicon Valley Bank, SVB, which is known for providing financing for Silicon Valley's tech startups, disclosed that the company is deep in financial trouble. As its deposits continue to shrink, it announced capital increases and discount bond sales to raise urgently needed funds. There's a piece of news that SVB CEO Becker sold $3.6 million, about 1.11 billion Taiwanese dollars, of company's stock less than 2 weeks before the bank collapsed, apparently knowing about the bank's bankruptcy ahead of time. Upon hearing this news, Kenshin, was first reminded not of the Lehman moment, but rather of the financial panic that occurred in the United States in 1907, also known as the Knickerbocker Crisis. This 3-week financial event, what exactly happened? Let's go back in time to 1836 when the charter for the Second Bank of the United States expired. President Andrew Jackson took no action to extend the charter, leaving the United States without any form of a central bank. During that time, New York's money supply fluctuated annually with the domestic agricultural cycle. Every autumn during the harvest, people purchasing agricultural products caused an outflow of funds. In order to keep its money in the country, banks raised interest rates to attract deposits, and foreign investors would take advantage of these high rates by remitting money to New York. When the San Francisco earthquake occurred in April 1906, a large amount of reconstruction donation funds flowed from New York to San Francisco, further destabilizing the New York financial market. In July of the same year, the Hepburn Act officially depreciated railway securities because the act set a maximum railway rate by the U.S. government's Interstate Commerce Commission. Between that September and March of the following year, the stock market slid and caused a 7.7% capital outflow. Even the 1907 stock market crash was called the rich man's panic, because the market fell by a staggering 9.8%. On July 27, the Commercial and Financial Chronicle stated, "The market continues to be unstable, new signs of life have yet to appear. The fresh onslaught of gold external drain is shaking the financial world. All hopes that might appreciate have presently vanished." There were multiple bank-run incidents overseas in 1907, including Egypt, Japan, Hamburg in Germany, and Chile. If you are familiar with the financial industry, you would know that the fall is the most vulnerable period for the banking system. Even a slight shock could lead to severe consequences in the chaotic securities market. The main event begins now. The bank panic of 1907 began with a stock price manipulation operation targeting the United Copper Company. The owner of the company, F. Augustus Heinze, also a bigwig in Montana's Butte copper industry, had accumulated a significant fortune. In 1906, he moved to New York and formed a close association with the notorious Wall Street banker, Charles W. Morse. Morse had successfully monopolized New York's ice market. Together they controlled many banks. Indeed, Hyde and Morse had held positions in 6 national banks, 10 state banks, 5 trust companies, and 4 insurance companies. They possessed extensive connections and intelligence in the financial industry. The instigator of this event was actually Augustus's brother Otto. He believed that their family already controlled the majority of the copper company's stocks, with a good number of stocks already loaned out and sold. He was thus convinced that short sellers would anticipate a decline in stock prices and then be able to repurchase the stocks that they borrowed at a lower price, making a profit from the difference. This is known as short selling. In response, Otto proposed a «short squeeze» plan, whereby the family would purchase as many remaining stocks as possible, forcing short sellers to pay for the stocks they had borrowed. This aggressive purchase would directly inflame stock prices, and as short sellers would not be able to purchase stocks from elsewhere, the family would become the only choice, and they could name their price to these people in dire straits. However, while the plan is simple in theory, the amount of funding required to achieve the goal was no small sum. Consequently, to raise capital for the plan, Augustus and Charles W. Morse met with the president of New York's third-largest trust company, Knickerbocker Trust Company, Charles T. Barney. This is because Barney has previously funded Morse's last acquisition action. Since Morse reminded Otto that the required funds would be more than initially planned, Barney, aware of the situation, refused to provide the funds. Unbelievably, Otto was determined to implement the plan. Starting from Monday, October 14, Otto aggressively purchased stocks of the United Copper Company, which rose the stock price from $39 to $52 in just one day. Added to this, Otto demanded short sellers to return the stocks they borrowed the next day, driving the stock price to nearly $60. The problem was that Otto misinterpreted the market situation. In reality, short sellers had more sources to obtain stocks than just the Heinze family. The result was that the stock price of the United Copper Company crashed overnight. This failure caused Otto to be unable to repay his debts, and his company, Gross and Kleberg, had to file for bankruptcy. Consequently, on Thursday, October 17, the American Securities Exchange took actions to suspend Otto's trading rights. The collapse of the United Copper Company's stock also led to the bankruptcy of the Montana Savings Bank of Butte, owned by Augustus. Since the Montana Savings Bank held a substantial number of United Copper Company's stocks as loan collateral, and it was also the agent bank of the National Commercial Bank in New York City, where Augustus was also the president, this created a serious problem. Due to Augustus's market manipulation and the ensuing bankruptcy of the National Savings Bank, the board of the National Commercial Bank could no longer tolerate him. Although they pressured Augustus to resign, it was all too late. As news of the bank's bankruptcy spread, more and more depositors rushed to withdraw money from the National Commercial Bank. Even though the National Commercial Bank had enough funds to support large withdrawals for a few days, this wave also hit Augustus's partner, Charles W. Morse's own Bank of North America, and New Amsterdam National Bank, both of which experienced bank runs. To prevent the two men's notorious actions from affecting the banking system, the New York Clearinghouse forced the two out of the banking system. Even though the market manipulation incident did not harm the financial system until the weekend, because even if money was withdrawn from Heinz's bank and deposited in other banks, the money still stayed within New York City. A week later, many securities exchanges in the United States were closed or restricted. For instance, the Pittsburgh Stock Exchange suspended trading for as long as 3 months beginning on October 23, 1907. This was when the previously mentioned Knickerbocker Trust Company came into play. It was the third-largest trust company in New York. On October 18, the squeeze wave affected the Knickerbocker Trust Company. Therefore, on the 21st, the board of directors of the Knickerbocker Trust Company asked Barney to submit his resignation. Their reasoning was that they had past dealings with Morse and Augustus, but that wasn't entirely unfair. After all, Barney had funded Morse before. The news again spread, and other banks and trust companies did not want to continue lending after knowing about it, and the brokers of the stock exchange were powerless to look at a 70% loan interest rate. Since brokers couldn't borrow money, the stock price hit a new low since December 1900 that day. The other two major credit companies, American Trust Company and Lincoln Trust Company, were also affected. Beginning on Thursday, October 3, the bankruptcy situation of many financial institutions could be described as overwhelming, including the 12th Bank of Ward, the Empire City Saving Bank, the New York Hamilton Bank, the Brooklyn First National Bank, the New York International Trust Company, the Williamsburg Trust Company in Brooklyn, and the Jenkins Trust Company in Brooklyn and Providence Union Trust Company, etc. High-profile financial institutions, to say the least, were not spared. Just as the major New York banks were losing confidence because of the chaos, The most renowned banker, J.P. Morgan, was not in New York. He was participating in a church meeting in Richmond, Virginia. Morgan was not only the wealthiest and most well-connected banker in New York, but he also had a lot of experience handling similar crises. For example, during the crisis of 1893, he helped the U.S. Treasury Department through the difficult times. He returned to Wall Street late Saturday night on the 19th, and he had to face the impending crisis early the next morning. Morgan and his partners inspected the accounts of the Knickerbocker Trust Company, determined that the borrower could not repay the debt and decided not to intervene in the bank run. On Tuesday, October 22, the president of the American Trust Company asked Morgan for help. That night, Morgan met with George F. Baker, president of First National Bank, James Stillman of National City Bank of New York, and George B. Cortelyou, Secretary of the U.S. Treasury. Cortelyou stated that he was ready to accept government deposits to protect bank savings. After an all-night auditing, the results showed that the American Trust Company was in good condition, and on Wednesday afternoon, Morgan announced, "The rectification begins now." Despite injecting a large amount of cash, New York banks were unwilling to provide normal short-term loans for daily stock trading, causing stock prices to plummet due to a lack of financial support. At 1:30 p.m. on Thursday, October 24, Ransom Thomas, president of the New York Stock Exchange, stormed into Morgan's office and emphatically stated that early closing was unavoidable. Morgan, however, urged him that an early closure would bring about a financial disaster. Immediately, Morgan gathered all the bank presidents in New York and conveyed a message to them. If they could not raise $25 million to save the market within 10 minutes, as many as 50 stock exchanges would close. Although this crisis was resolved, it didn't mean the end of the crisis. Before Saturday, November 2, New York seemed to be basically calm, but another crisis was imminent. Moore & Schley, the largest commercial firm in trading, was heavily indebted and on the brink of collapse. Since the company had borrowed a large amount using the stocks of the Tennessee Coal, Iron, and Railroad Company as collateral, when the stock market began on Monday, bleak transactions threatened stock values. Many banks wanted to call on Moore & Schley's loans, prompting a massive liquidation of the company's stocks. But if they actually did so, it was not surprising that the stocks of the Tennessee Coal, Iron, and Railroad Company would collapse, and Moore & Schley would cease to exist, triggering a major market crisis. To save Moore & Schley, Morgan called an emergency meeting in the library on Saturday morning and proposed that the United States Steel Corporation acquire the Tennessee Coal, Iron, and Railroad Company. The U.S. Steel Corporation was created by Morgan through the merger of Andrew Carnegie's company and Albert Gary's company. His actions would not only rescue Moore & Schley but could also turn the tide of the crisis. Hence, the decision-makers and board of directors of the U.S. Steel Corporation seriously studied the situation, whether to lend $5 million to Moore & Schley, or to acquire Moore & Schley at $90 per share. But they didn't reach a consensus and had to postpone the decision. The following Saturday, almost 50 bankers came to the same place. Just before midnight, Morgan told a leader in the trust industry, Moore & Schley needed $25 million to continue operating. He could solve the funding issue, but the problems of Trust Company of America and Lincoln Trust also needed to be solved. At this point, the decision-makers of the trust companies knew they had no other option. Either save the two trust companies together or wait to die. Adding to this, Morgan clearly told them, either accept the conditions, or the entire banking system would collapse. Under his immense influence, shortly before 4:45 a.m., the informal leaders of the trust companies signed an agreement, and the remaining bankers also signed the agreement. Morgan let everyone go home only after getting a written promise. Henry Clay Frick and Albert Gary of U.S. Steel traveled overnight by train to the White House to ask President Roosevelt to temporarily shelve the Sherman Act and allow this giant company, which held 60% of the national steel industry, to carry out another major acquisition before the market opened. Although the Secretary of State did not see the two of them, they convinced Secretary of the Interior James Rudolph Garfield, so they arranged for a meeting with the President bypassing the Secretary of State. Finally, after the discussion, Roosevelt gave in. Later, when recalling this meeting, he said, "I had to make a quick decision before the opening. At that time, the situation in New York was pessimistic, and life and death might be within an hour. Even if I didn't agree to the acquisition in this situation, I should not be blamed simply." This news reached New York and quickly boosted people's confidence. Journal of Commerce and Commercial Bulletin reported, "This timely transaction has far-reaching effects, and we have overcome the last hurdle."